All right, Eurodollar on a 5-minute chart. We will see charts with Asian range and central bank dealers range. I'll do all those things. But in the beginning, you need to see these patterns, these things that I'm showing you right here, because this is the majority of what it takes for you to understand all that other stuff. That's what you want right now. You want the precision entry, the precision exits. Make me money. Make me money. That's what you want. Okay. But I'm telling you how to get to that level. And you need to see these things happening. What is it you're supposed to be seeing by doing this, by the way? By having your charts annotated with the kill zones, it teaches you there's specific turning points intraday that take place. And then there's price runs that occur from those kill zones. A kill zone is a specific time of day, like 2 a.m. to 5 a.m. New York time, 7 a.m. to New York time, 10 a.m. to noon New York time. So you can see there's a turning point here. It runs. It creates an optimal trade entry here. Comes back a little bit deeper, but this to New York is still an optimal trade entry as well. And price runs through into the SIBI. And it hits this high prior to 2 o'clock in the afternoon. It creates the high here during the London close. Low of the day in London. High of the day in London close. Continuation pattern in New York. This is a model. If you anticipate this and finding this once a week, you never need to do anything else. I'll teach you lots of other things. But if you can see this pattern here as your model, you don't learn anything else except for just making this one better. You will be financially independent. If you can control yourself and control your money management and not overtrade, this pattern right here is it. That's all you need. And you only need to find one of them a week. Now, what does that look like? Well, you can wait for London to form and sleep all through the night and wake up around 6:30 in the morning, New York time, and be in front of your charts until around 9 o'clock in the morning. Your setup's going to form prior to 9 o'clock. If you don't have your setup by 9 o'clock and you miss it, then you look for institutional order flow entry drill because you probably missed the initial run and you have to catch something in here on, maybe a 1 minute chart or something like that. Now, again, you're going to learn lots of patterns and ideas how the algorithm operates, but this is one that's just really easy. It's generic. And by looking at the charts with that perspective, it just feels much more confident. You start seeing price runs like this, it's hard not to smile and think, man, where am I going to be at 2 years from now? Where am I going to be at 5 years from now? But this pattern here of finding the turning points intraday, low of the day in London, continuation in New York, high of the day in London close, that is classic buy day scenario. It's classic. Where do you find this? When the market's predisposed to go higher on the 4-hour and daily, within the context that the weekly chart could expand higher. Now, I just gave you a mouthful, but all those things together combined, if you have those, this pattern here is easy to locate, very easy to locate. And the market creates a mitigation block because we have a high, a low, a lower high. So the down close candle in between, it's this to here. You extend it out in time, and then we bump up at the bottom end of that sell side imbalance, buy side inefficiency. Again, all the things I showed you on the hourly chart and the 15-minute chart, that's this level being transposed. So this is what we got for the 28th of January for Euro. Let's go into the 29th. Real quick, this one here, obviously you can see it's going up, but just not what I would have remembered as a new trader seeing and thinking. This would have made no sense to me. But using the annotations now, London open kill zone, market trades down to that rejection block. It finds some support there, rallies up, trades back down into the order block here, rallies up, small little fair value gap there. Look at the bodies right into that, right there, fills it in right there. Yes, we have a tail. Yes, we have another tail, but it's the bulk of the volume inside the bodies of the candle. That's what I'm focusing on. I'm not worried about the wicks because my stop loss is always outside of the realm of within its reach or a broker's spread. I'm not trying to trade with the myth of 2-pip stop losses because they don't exist. The price runs from the order block up. One more time, trades lower. Small little rejection block there. Runs up. Order block, down close candle. Fair value gap again. Trades down into the order block with a fair value gap. Which order block do you buy, Michael? The down close candle with a fair value gap with the context that's bullish. What's it reaching for? That fair value gap. Is it reached that fair value gap from here? No. We have potential for this order block to be touched and trade up to the low under the fair value gap. Not consequent encroachment, not the high end, just reach and touch that level there. So what's the framework that your eye should be training to find a repeating phenomenon in by seeing this example? Well, you have a fair value gap with an order block. It's running up. This is also not during the easiest time to trade. This is when the real setup forms in London. Here, we're between New York Open and London. But if you see this formation, there's nothing wrong with taking that as a trade because this is a institutional order flow entry drill on this candle or trading down to the fair value gap closure or consequent encroachment, which is the midpoint of the gap. When we trade down into this fair value gap here, it creates another run, which creates another fair value gap here and consecutive down close candles, which is a bullish order block as well. This small little imbalance needs to be rebalanced with what? A down move in between this candle's low and this candle's high. So we have a fair value gap in here. Order block is being identified here for the purposes of this annotation, which is fair value gap and bullish order block. So it's the order block that's being anchored, but the fair value gap would be this candle's high, this candle's low. Which order block do you buy, Michael? The order block that's down closed with a fair value gap with a context that's bullish. In here, buying this, you're at the beginning of the New York kill zone. Yes, this is a good one. Do you have range between where you're trying to buy and where you think it's going to go? Well, you think it's going to go up to this fair value gap. What's the easiest low-hanging fruit target? The low end of the fair value gap. So you can buy here. As soon as it touches here, you limit out, you're done. What's wrong with that trade? Nothing. Until you have to ride this here. Because you're too quick as it starts to run up. You're in a hurry to take your stop loss and jam it up in to lock in something. So you have an optimal trade entry from low to high to low. So there's an optimal trade entry for New York Open. And you also have a New York Open low to high down into optimal trade entry here during New York Open. Then the price runs up into the fair value gap low and beyond it just by a little bit and consolidates in it. And then in London close, we create a lower high, which again, I mentioned, it's going to happen. It's just a target for time, but it creates a significant high there and doesn't go any higher the rest of the day.